Meantime, the state of the economy, the accuracy of data, and the future of the Fed, they are all the big topics of conversation right here at the Aspen Economic Strategy Group forum that's taking place. And last night I sat down with former Treasury Secretary and Fed Chair Janet Yellen. This is what she had to say about what's going on.
I think that perhaps the most recent data strengthens the case for some rate cut going forward. Of course, the markets have long expected there to be some rate cuts. It's, of course, contingent on the data continuing to show that inflation's under control and based on perhaps seeing some weakening in the labor market. But the recent data suggested both a meaningful slowing of growth and kind of a stalling out in the labor market.
We also talked about President Trump and his plans for the Fed.
I think President Trump has made very clear that he wants to appoint somebody who will be inclined to lower rates. And now the rationale that he's given and the magnitude of rate cuts that he has suggested he regards as appropriate, I think should be frightening to markets, because he said that the reason he thinks we should cut rates is that America should have the strongest credit rating in the world. We're a significant borrower, and he wants to see the cost of U.S. debt come down. And so he's suggesting tying monetary policy to helping the Treasury pay interest on the debt, which is an argument that is really out of bounds.
Joining us right now is Blair Effron, co-founder of Centerview Partners, a corporate advisory and mergers and acquisitions firm that has advised on more than $4.5 trillion, that's with a T, in transactions. So she says it's out of bounds and, by the way, frightening potentially to lower interest rates the way the president is suggesting. There's a lot of economists here, former Treasury secretaries and the like. What is your take about where the economy actually is based on some of the conversations here, but also you're spending a lot of time with CEOs around the world and how they're feeling?
So, Andrew, let's talk about where the economy is. First of all, thanks for having me. But where the economy is and where it might be. Where the economy is actually pretty good. We started out the year, GDP estimates with most economists, 1.5–2% growth. Most CEOs actually would dial in 2% into their planning process. The fact is, we just got through the second quarter earnings. 80% of companies overshot estimates. Revenue for the quarter on the S&P 500, 6.5% growth. Companies starting to spend capital at quite a robust pace versus last year, of 5%. Obviously, AI, 5 companies, $300 billion. That will continue. Consumer, I know there's been some cracks, but frankly, look at Disney's numbers this morning, strong. The consumer has been in better shape. Confidence has been up, Michigan Index. And finally, you and I have talked about before, AI is absolutely having an impact favorably in terms of what companies can earn. But that's where we are. The big looming question is where we're going. It's hard to imagine that with tariffs kicking in the coming months, and whether it's 18%, 20% where you end up, if you're 8 or 9 times what it was before you got into this, it's hard to imagine you don't have a headwind. Companies will not continue to eat the cost of increase. And on the other hand, they'll be loath to see their margins go down.
Are you surprised that they haven't, or that they've been either eating increases now or they haven't already raised prices? The reason I ask about that is because I think there was a fear back in April that companies were going to take up price almost immediately. In part because that's what we saw during the pandemic. People were trying to get ahead of inflation back then, and they were taking up price long before it was actually even hitting them. This time around, they haven't done that.
Not surprised at all. Why? I think pricing got too aggressive. The consumer walked with its feet. You saw volumes for most companies in most sectors go down, whether it was experience and entertainment, whether it was consumer, whether it was retail. So getting that price-value relationship back in line, important, one. Two, as I said, AI is really having a big impact. You've seen some numbers that it's already hitting positively GDP 25, 50 basis points. I think companies, because they are so nimble and because they are so good at being efficient and quick and maximizing revenue, we're able to eat the cost.
Right.
But remember, most of it has not come into play yet.
Okay, CapEx spending and M&A deals.
They go together.
All of which go together because it's about confidence. And the question is where the tariff cloud lies in that story.
So right now, M&A is actually on the upswing. I think it will be continue to do so the next 2 quarters. Remember, when I was here last, I was negative. I was wrong. Last year, the market finished at $3 trillion. I can see being at $3.3 trillion this year. You don't have a Norfolk Southern Union Pacific transaction if you think the economy is going to go into a big headwind.
Right.
CEOs want to go into a transaction at close with some momentum. You already have 22 transactions valued over $10 billion or so for the year. This is a pretty good pace, and I think based on the dialogues I and a lot of my colleagues at various firms are having, you should expect a pretty busy fall. Now, that says, and these are smart people, everybody thinks rates will have an impact. The question is, tariffs will have an impact, but is it so much to have a different view of the economy? I bet the economy hangs in through 25, 26, all bets are off.
Okay, what about the regulatory environment? The whole idea is that everything has opened up, right? That open sesame. Is that true?
No.
Okay.
It is not true. The regulatory environment remains closer to the Biden administration than the other side of the spectrum. Now, I do think in certain industries you're going to see the regulatory environment improved enough. National institutions, for example. We have a very healthy set of banks. We just went through the stress test. $650 billion of loss was seen as acceptable. They could get done. You have a fragmented industry, 4,500 banks. You have 4 big banks, a phenomenal institution, J.P. Morgan, bigger in market cap than the other 3. There is a compelling reason to responsibly have another 1 or 2 big banks. You've already seen a couple of data points transactionally. So I think that regulatory environment.
Okay, so we're going to see banking deals is what you're trying to hint at.
I'm not saying immediately, but it's going to be a different environment for an industry where you haven't seen banking deals in a decade.
Okay, what about big tech and media?
So media will continue to consolidate. It's an industry in flux because of so many non-traditional players making such an impact, the Apples of the world, the Amazons of the world. And the fact of the matter is, most media companies, it's not just content. They're media, content, they're tech. And if you haven't figured out the confluence, it's problematic. You should expect there'll be more transactions.